Hi, everybody. This is Boris Schlossberg with BK Forex, and we're going to start right away because I got a lot of stuff to get through. It's going to be a fascinating hour. I may have to actually go with you a little bit longer than an hour, so if you want to hang with me, please do so. Any questions you have, feel free to post them in your chat box. I'm happy to answer whatever you guys have on your mind. I'll keep the questions to the end though, as I go through the presentation. So I wanted to welcome you to our 2020 market outlook, and also suggest some of the better trade ideas I think that we may have for this year. My name is Boris Schlossberg. I work with BK Forex, and of course, as always, when we start out, please read this disclaimer. I understand that past performance is not indicative of future results. The trading Forex carries a high level of risk, may not be suitable for all investors. And as always, you should consult an advisor depending on your objective as an investor. So lots and lots of news in 2020, and I think the single greatest essence of the 2020 year so far is just the utter surprise and unexpectation of how things have evolved. I mean, if I just sort of laid out a thesis for you that we're going to have the greatest pandemic in 20 years and markets would go to all-time highs, nobody would believe it. We'll talk a lot about why that's happening and what's really going on. But we'll also talk about commodities and indices and where we see some of the better trades into the year. So some of the key themes in 2020 as we enter. First of all, in 2019, everybody cut rates. And I think in many ways, that is really the fundamental force that's driving everything else as we enter into 2020. But US cut rates by 75 basis points, Australia did, New Zealand did. The big questions, as a matter of fact, we have the big question in your neck of the woods in New Zealand coming up later today. Although as everybody tells me, it's actually tomorrow because the RBNZ decision is Wednesday to New Zealand, but Tuesday to New York. But as I said to somebody on Twitter, the world revolves around New York, so it's on Tuesday. I'm just kidding, guys. But the point being is that everybody is still in an easing mode, although they have stopped cutting rates for now. The really big question is going to be whether they're going to continue to go lower. We saw the RBA. I'll talk a little bit about that later, obviously, but we saw the RBA. I think sort of the net takeaway from all the central banks right now is under no circumstances do they want to cut rates any further unless they absolutely have to, because they have so little room to work with. Almost everybody in the world is Japanese, meaning that they're almost all at zero rate interest rate at this point, and that's something that they want to avoid as much as possible. Now, the fallout from this, the absolute fallout from everybody having very low rates, is that we've had literally no volatility in FX. And if you think about it, of course, it makes perfect sense. FX or currencies are essentially tiny short-term bonds, right? Every currency has a yield on it. So if there is no prospect, if there's literally zero chance, the mantra that everybody on Bloomberg spouts now is lower for longer. Lower for longer means basically that interest rates are going to stay lower for longer. Oh, hold on a second. I'm sorry. Nobody's seeing my screen? Oh, I'm sorry. Hang on a second. I just started and hang on. Show. No. Oh, I'm sorry, guys. My bad. Okay, I keep talking and I just realized I didn't show the screen. Okay, now you guys should be seeing the screen. So sorry. Okay, we're back to the screen. My apologies. Okay, so wonderful you got my voice for the first 5 minutes of the presentation, but now I'll go through the slides just to show you exactly what I was talking about, which is that in 2019 everybody cut the rates, as I was saying, and now everybody's really holding on because they don't want to cut rates anymore. Now the end result of all of this is that the volatility is at record lows. And as I was saying just a second ago, the reason why Forex volatility is at record lows right now is because interest rates are so low. They're completely interconnected. If you're trading currencies, the main reason currencies go up is interest rate changes, right? Up and down. Because what's the value of a currency? What's the value of euro or pound or Australian dollar? It's how much yield it's going to give you. That's the fundamental value of a currency, right? The yield on a currency is like a dividend on a stock, right? That's really the reason. So the higher the yield, assuming there's no inflation underneath it, the higher the real yield, that's really what I should be saying. In other words, the higher the real rate of return on a currency, the more likely it's going to start popping. But when everybody in the world is basically sitting and saying, hey, we're going to stay lower for longer, we're not going to raise rates this year, next year, maybe for the next century, it's very, very difficult to get excited about trading something that has very little variance in it. And that's what you're seeing. That's why you're seeing Forex volatility at record lows. That's the key thing that's kind of driving everything to the downside. And VIX is also at lows, but nowhere near as low as FX. FX, if you've been trading it, has been a monstrous challenge to trade because the ranges have just been pathetic. I mean, look, this is the euro rate. It's just pathetic, right? Really, there's nothing going on. So I'll have some ideas of how we can take advantage of that. But that's sort of been a takeaway from this year as far as trading in terms of volatility. And of course, overlaid on that, we have all sorts of policy uncertainty. We have the trade war with China, we have Brexit, we have political chaos in Hong Kong, we have Trump, always a chaos. Trump is #1 chaos agent in the world. And of course, now we have the virus. So the virus is the big story. And I've had to become a epidemiologist. I can never pronounce that word. Over the last month and a half, I know more about RO values and protein bindings and things that I never thought I would learn about that I care to know. But here's the bottom line, just from an investment point of view. So let's just talk a little bit about the virus first before we get to sort of why it's not having an impact. Virus is horrible. From a medical point of view, there's zero doubt that it's horrible. It is sort of like the worst of both worlds. It has the kind of very, very nasty acute respiratory distress syndrome aspects as SARS. It kills a lot of people, a lot more than what they're telling you. And it is highly contagious as well, right? So the amount of cases, this is a completely outdated graph. It's already in the 40,000s. Globally, it's spread to I think 27 countries at this point, and it's already exceeded SARS in its death toll, right? So the big question is, like, why has it not? Is everybody hearing me? By the way, somebody, I'm sorry, just give me one more time sound check. If somebody's not hearing. Somebody is hearing me. Yeah, okay, sound is good. Just if you're not hearing me, just for those of you who having problem with sound, log in, log back out. That's so I just wanted to make sure that the sound was good on my part. So the virus from a medical point of view is horrible. I don't want to go into the conspiracy land. There's just literally 1,000 things I can say about the virus, including what are the real statistics, what are the official statistics, where are the rates. Today, the happy sentiment is a result of the fact that there is a slowdown in the rate of change, just the rate of change of new cases. So the belief is that the virus may be contained. Um, really, from an investment point of view, let's just set aside the moral, the ethical, the medical components of this, which are indubitably horrible, and in the end will no doubt result in tens of thousands, perhaps even hundreds of thousands of deaths because it's truly a vicious little bug. From an investment point of view, there are two things that that the markets are completely sort of pacified with and are ignoring the virus for this reason. Number one, and take it for what you may, but this is literally the reason why I think the markets are much more calm than they should be. Number one is we have not seen a pandemic outside of China. And that is giving investors perhaps a false sense of confidence that there's not going to be. What I mean by that is we've seen a few cases, we've seen infections, we've seen so forth, but so far, no significant amount of deaths, right? We had 1 or 2 people die across, but we haven't here's the horror and the reality of the world. You get 10 people in America dying from the Wuhan virus, from the coronavirus, guarantee you equity markets are going to collapse by 5%, right? 50,000 people in China, the markets are like, it's contained. So that's ultimately kind of the reality of what's going on in the marketplace. So the first assumption is it's deadly, but so far it seems to be only deadly in China, not outside, and that it hasn't really spread. And secondly, there is this belief that China does have this thing more or less under control. Now, the economic impact is definitely going to be severe. You see this all the time. You see Apple, you see Starbucks, everybody saying, "Oh, we're going to open tomorrow," and then they don't. Foxconn tried to open, and some of the plants have not been open. Half a billion people have been effectively quarantined in China, and it's unclear for how long they're going to, how long this is going to go. One of the problems, of course, is that it's a very non-transparent country. Data is not exact, and nobody really knows whether the virus has been contained or not. Regardless, almost everybody, I think, expects certainly a hit to GDP. The much bigger question, and this is where this is the other thing that I think is going to happen. If we don't have China back to essentially full productive activity by March 1, then yeah, capital markets are going to start reacting, because it doesn't matter that nobody is dying in the West. The mere fact that the supply chain of the world, 17% of the global GDP, is essentially offline effectively for all the month of February is going to start to impact risk as it goes forward, because there will be huge amount of breakage in economic activity, not just in China, but all across the world, as you're going to get shortages all around. And I think that's sort of the takeaway from the number one story of 2020 as we start here, is that the market right now believes it's not dangerous for the rest of the world. It's contained to China, and China will be back up online in March 1. If all those assumptions go by the wayside, this becomes the story that everybody thinks it should be, which is that it's going to be a massive negative hit to the world. And a negative hit to the world that, of course, nobody is anticipating, right? Everybody is in this kind of, we're in a steady and slow 2% growth in the US and 1% growth in Europe state. But all of that assumes that China, which is literally 20% of global growth, comes back online. And if it doesn't, then this whole idea of no recession, little growth also goes by the wayside. So everything is in many ways contingent on this one big Jenga piece of the Wuhan virus. Now, when we look at the manufacturing activity and basically the global activity prior to all of this events, it was already in a quasi-recession. Services may be just twiddling right above the 50 boom bust line, but manufacturing pretty much everywhere is really in a slow contraction. Already there is pretty much large inventory built and little demand. And I'll explain why that's happening in a little bit. But fundamentally, this is the key thing. Fundamentally, global economy is much weaker than what the global equity markets are showing you. And we'll try to understand why that's happening as we go forward. So, end of monetary easing, I think wishful thinking. If you sort of think that, well, let's put it this way. Rate cutting, possibly true. The central banks, as I said, are not going to cut rates much further than they already have because they desperately want to have a margin of error. They want that ammunition for the situation when things really get bad and they need to cut rates to stimulate the economy. So the 0.5%, the 1%, the 0.75%, the 1.25% that they have in their pocket, they really want to, they're desperately hoarding that last interest rate easing because otherwise they just have no policy tools left. But it doesn't mean that they're going to begin to contract their balance sheets or they're going to essentially tighten monetary policy. That, especially with the Wuhan virus, definitely not the case. Today, we have Fed Chairman Powell testifying in front of the US Congress, and it will be fascinating to see what he has to say. He's an incredibly circumspect and very careful guy, so I doubt he's going to make much news. But if he says, yes, we perceive this to be a significant risk, and yes, we stand ready here to ease credit as much as necessary, that will be just yet another shot of hopium that the equity markets may finally get. If he, is relatively nonchalant about it, I think actually the equity markets will react pretty negatively because they expect that they are going to help. Now, again, return of carry, very, very premature. I think at this point, the idea that things are going, things will rise even in emerging market countries, incredibly premature. If nothing, we're going to spend 6 months just nursing our wounds from the unexpected shock of the Wuhan virus. So I think that scenario of expanding interest rates, very much wishful thinking. The consensus view is lower for longer. The non-consensus view is that we may actually go down even more and cut rates even more. So the carry trade still stays pretty much at bay. Now, the true story of what's going on across all asset classes is that the Fed controls all. Really, the whole history of the last decade has been the fact that central banks have used their unlimited power to print money by expanding their balance sheet, by essentially writing an IOU without any kind of a backing. Remember, the central banks create money out of thin air. They say imagine you're walking down the street, you see a building, and you say, how much is that building? And the guy says $20 million, and you say, here's my promise to pay $20 million. It's as good as gold, and it effectively is. That's what the Fed does with every asset in the world. It essentially says, I'm buying it on my word. Imagine if you had that power. So the power has been very, very, very good for equities because the Fed has expanded its balance sheet now to $5 trillion by buying everything in the world, and that creates demand, and that demand translates into higher and higher and higher financial assets. That's really been the very, very big story of why equities go up. All other reasons, in my opinion, every other reason is nonsense. It's complete and utter nonsense. In other words, companies doing better, profit margins, equities, low interest rates, none of that matters. Literally zero impact. If you're buying equities based upon some fundamental reason, you are playing the wrong game. The only game that matters in the equity market is central bank balance sheet expansion. And you see that when they kind of taper their balance sheet, right? When the balance sheet does not expand, equity markets start to really go down, and they have lots and lots of like 20% declines here, big wiggles, right? Sorry. So the one exception to this rule is when you don't have equity, when you don't have balance sheet expansion, you had the huge U.S. federal budget expansion. We have a $5 trillion budget now, in addition to a $5 trillion balance sheet, of which more than $1 trillion is a pure deficit. So this was the pure deficit shot of hopium, and before that was all balance sheet expansion. And so the question now is, if the Fed does not expand the balance sheet any further, and the federal government can't really borrow much more than it can't expand the deficit by more than $1 trillion. This leaves equities in a danger zone, because the only thing that makes them go up is these two things. Everything else is nonsense. So this is where I think I'd like to just take a minute to explain why and how the way testing. So there's still people saying that they have no sound. I'm just looking at audio. Has everybody? Just one more time. I just want to make sure. Just text me here saying that you have sound. Yeah. Okay. Okay. Everybody, somebody else in the room. Just tell me you guys are hearing. So I just want to make sure that you guys are hearing me. Yeah. Okay. All right. Well, I have a couple of people telling me they have no sound, so they have to log in, log out. I just want to make sure that we're good. Okay. Regardless, this whole thing is going to be taped, and we will send you the recording, so you guys will have everything correct. Yeah, sound is good. Okay, so it looks like all the sound issues are on the back end. I just want to make sure, because I don't want to be speaking into a void. So this is a very important mechanic of how the Fed works. If you understand this, you understand a lot about how and why markets trade. So what is quantitative easing in layman's terms? It is not what's called helicopter money. Helicopter money is, imagine a central bank, let's say the Reserve Bank of Australia, the Fed, anybody else, says, hey, Mr. Smith, I'm going to drop 1,000 Australian dollars. Hey, Mr. Jones, I'm going to drop 1,000 American dollars into your bank account. I'm going to literally deposit $1,000 into your bank account every month for the next 12 months. And you can do with it whatever you want. It's real money. It's like a salary for doing nothing, right? Now, the Fed actually, all the central banks have that power. They have the power of the checkbook. They literally can make a transaction, a ledger transaction, and say, drop that money into everybody's account. That's helicopter money. So when you get helicopter money, right, what's the first thing that happens? When people get money, especially people who don't have money, what's the first thing they do? They spend it. When they spend that money, businesses sell more goods. They then order more goods from their suppliers. Suppliers produce more goods, and the economy goes into a true growth cycle. That's demand. That's how demand is manufactured, right? So QE is not that, unfortunately. QE is the Fed saying, okay, I'm going to use my power of my checkbook, but I'm not going to give everybody money. I'm only going to go and buy bonds. I'm going to buy every bond there is. I'm going to buy sovereign bonds, corporate bonds, you name it. So I'm going to go buy bonds. So what does that mean? That means the 1/10 of 1% of 1/1,000,000th of 1% of the population that actually owns bonds. I'm being facetious, but you get the idea. That means everybody who's rich gets richer, because that's literally what's happening. Who owns 99% of all bonds? 1% of all people, right? You ever know somebody who's making 30,000 Australian? or somebody who's working at I don't know, just has a regular job. Somebody who even has like, even if you're an accountant, you don't own bonds. Even if you're a dentist, you don't own bonds. It's only if you're a millionaire or a billionaire that you own lots of bonds. So the Fed says, thank you very much. I'm going to take my money and buy more bonds, which means that everything that you own now is worth so much more, right? Not only that, but like, let's say you started out with, I don't know, 100 million in savings, and now the Fed bought everything, and now the value is worth 200 million in savings. So now you have twice as much money in your savings account. Thank you to the Fed, and keeping rates near zero. So what does that really do when you look at the mechanics of that dynamic? That actually produces asset bubbles. It produces little growth in income, but it produces massive growth in asset bubbles. Let me show you what I mean. Average, this is US wages, but it's the same true all across the OECD. So the US average wage in the last decade, that's the last 10 years, right? From the beginning of 2010 to 2020, you started at, I don't know, $10,000, you have $13,000 that you're now making, 37% growth, right? On the other hand, if you dropped your money into the S&P 500 or into any kind of equity index, your rate of return is actually now more than 300%. And we'll continue to, as I'm talking today right now, the stock index futures are making fresh all-time highs, right? So you see the difference. It's a 10-to-1 difference. It's actually much more. That is basically driving everything in the equity markets. Literally, everything I tell you is a footnote, except this part of the presentation. If you understand the fact that central banks control all, you understand pretty much why markets are going the way they're going. And you also understand why Trump is so adamant about the Fed lowering rates and even creating more liquidity into the markets, because Trump's whole campaign is based upon the fact I tripled or I doubled the stock market for you. It's the greatest economy in the world. So understand that those two statements have zero in common. I doubled the stock market for you means the 1% of the population in the economy has doubled their net worth, and 99% of the population has gotten a 70 cents raise on their wages, which is really what the economy is. So you have this incredible disparity between the real economy and the fake economy, but Trump is taking full political advantage of the fake economy, and it's working. And he's having a very, very powerful, strong impact. So his reelection strategies is pretty simple. He wants to drive up the unfavorable ratings of his Democratic rivals, paint everybody essentially as a communist or a socialist. He wants to drive up the value of stocks even higher and higher and higher. Perhaps creates fears of war at this point. I mean, I think really the first two is really what his strategy is. And the conventional wisdom in U.S. political circles is that it's his election to lose, and it very, very well may be. But I caution everybody about if there's anything even less predictable than making financial predictions, it's making political predictions. One thing that's kind of interesting right now, just from a political front, I'll just spend about 5 seconds on this because it's really not a material to how we trade, is we have I think a surprise emergence of Mike Bloomberg. Now, Mike Bloomberg was a mayor of New York City. I'm a New Yorker. Everybody who's a New Yorker, would make him a president for life if they could, because he was the greatest mayor in the city. He may be a billionaire and an oligarch, but he was an incredibly terrific manager and really knew how to get things done. So he may be a much more viable challenge to Trump than Trump expected. I just make one final comment on politics. Trump's #1 mandate was to destroy Joe Biden in the US election, because he saw Joe Biden initially as his biggest threat. Now, the irony of the whole thing, oops, sorry, my my alarm's going off here on stocks. That's an alarm, by the way, that equity indexes futures are making fresh highs right now, which they are. So the irony of the whole thing is that Joe Biden was viewed as a presumptive, real challenge to Trump. But Joe Biden's mental faculties are even less than Trump's. So at this point, Joe Biden has been essentially destroyed for all intents and purposes by Trump. I think it's doubtful he's going to be able to come back. And now Trump's views this as a win, but I think it's actually an incredible blessing in disguise, because Joe Biden, if he had gone to full general election with Trump, probably would have lost, because contrary to conventional wisdom, which is almost always wrong, he's a really weak candidate. He was a weaker candidate than Hillary Clinton was in some ways. And his mental faculties are really going by the wayside every day. So the irony of the whole thing is that by destroying Trump, he's actually enabled Mike Bloomberg, who I think could be a much more viable candidate. So that's my kind of quick view of the U.S. election. We'll see how that develops. Now, when you look at the election year, by the way, what's interesting, I think, is the only interesting takeaway from the financial asset world is that it's really hurt the euro and it's really helped gold. And these two things are really working right now, right? If you're going to draw some kind of correlation, I mean, from 2000 forward, like let's say the last 4 cycles, and always, by the way, always I like, what happens most recently is what's most likely to happen as far as correlation goes. So the fact that it was positive gold over the last 4 cycles, I think is really telling. And that it was more or less negative euro, really for quite a long time, is kind of telling. Now, the big story, I think, aside from equities, aside from low volatility in FX, is that gold is at a 7-year high. And that's a very, very interesting question as to why is that happening. So first of all, yes, we have political risks. Number 2, yes, we have this massive deficit spending. Number 3, yes, we have the Fed balance sheet expansion. So 4, I think, is interesting. I don't know if you saw the latest figures in Chinese inflation, but China has really blown up. Yeah, somebody says Bloomberg didn't do very well at Iowa. Iowa matters less than 0%, Sean. What's interesting about Bloomberg, and I don't want to get into a political discussion because you and I could be 100% wrong. Bloomberg's whole campaign is based upon destroying Iowa and New Hampshire as any presumptive states. The way the U.S. elections are working now, all of the really important states, the states that really matter, are going to be voting in March. And if he makes a big splash there, you couldn't care less about states that have less population than my zip code. So we'll see how it goes, but I think it'll be very interesting. Anyways, back to gold and inflation. Inflation in China is at like 6% rates, 5.5% rate now, because food inflation has really skyrocketed. That's a really interesting and perhaps disturbing dynamic, but one that is the reason for why gold, I think, is acting so well. The other reason I didn't put here that I think is very interesting is that for the first time in more than a couple of decades, central banks have been net buyers of gold rather than net sellers of gold. So yesterday, I tweeted out something, and I was shocked. Like, this became my #1 tweet of the day. What happened was yesterday we had a kind of an unusual situation where both equities and gold were rallying. Right? That's typically not a case, and it seems to have been a case much more this year than before. And I think a lot of people started to notice that, and everybody's starting to chime in. So watch that trend. The whole point is it's not impossible for both equities and gold to rally, and there's some trades to be made out of that particular dynamic. So what's ahead in Europe? In Europe, brighter times ahead? Yes and no. So there's reasons to be optimistic. Germany did avoid the recession, but now it seems to be headed right back. I mean, the latest news is Daimler Chrysler is going to let go of 15,000 people. Germany is incredibly leveraged to the Chinese manufacturing supply chain and just generally to the whole manufacturing world, and nobody's buying anything across the world. So that makes, I mean, Germany produces things and the world is kind of buying experiences, right? To put it simply, people are buying services, but they're not really buying things. And Germany really suffers as a result of that because Germany is not very good at producing experiences, just things. On the other hand, populism has definitely peaked more or less. And Brexit is kind of resolved. We'll talk about Brexit in just a minute. But generally, the Chinese Wuhan virus story could actually be much worse for Europe than for the US. And you see that in Euro today, or you see that in Euro continuously. It's just getting hammered as all the data out of the Eurozone continues to be very, very negative. Now, as far as the commodity dollars and your neck of the woods, Australia, New Zealand, and also Canada, again, we've had just one-way downward moves. Australia was at Australian dollars at a 10-year low, all because, of course, based upon the problems in China. I don't know if the Australian miracle of 28 consecutive years of no recession is going to come to an end this year, but I would say that if you're ever going to pick a time when the Australian economy could contract into a recession, this year would be as good a time as any, given everything that we know that's going on in China. Again, if China is back up to speed by March, I think everything will be forgiven and Aussie actually becomes a rally. If China is still hobbling along at 50% capacity by March, and we don't really see a quick solution to the virus problem, then we have a problem. Then we have a serious problem. So that's really where everything goes. Add the fires, add the exogenous risks, and you clearly have a lot of pressure on Australia to cut rates in 2020. But as I said, the RBA will resist with all their might as long as growth remains positive and as long as employment continues to still generate jobs, even if they're temporary jobs. By the way, if you look at the Australian jobs, they're all primarily temporary jobs they're generating. Still, the RBA is holding on to the thinnest of hope that the country can stay above ground, above water, and that is the reason why they're not cutting rates. New Zealand is going to be coming out tomorrow. They're expected to not say anything, but I think it'll be interesting because New Zealand is also incredibly vulnerable, obviously, to China in more ways than one, and it'll be interesting to see. New Zealand produces what's called soft goods, which is more like food and staples to China versus hard goods like iron ore, which is used for capital expenditure. But even there, it'll be interesting to see if the complete collapse of consumer demand in China really forces New Zealand to cut rates even further. Both are essentially under observation, to use a timely term of how the economy goes. The big story to me, the really big story to me, is Brexit, as far as trading story, because the consensus view is this: okay, so Brexit happened, the worst is over, nothing really bad is happening. UK is going to stand on its own feet. It exited EU, and all the Cassandras have been wrong, blah blah blah, so on and so forth. And I think actually quite the opposite. I think the worst is yet to come for United Kingdom, and the pain and the karma will be far worse than anybody imagines. Let me tell you why. I don't know if you followed the latest pronouncements of what's going on negotiations, but they're now fighting over tiny little stupid things like salmon fishing rights, right? Now, why does that matter? It matters because UK now has no power. So tiny little countries in the EU who have fishing rights or whatever, or their constituencies in those can basically go tell EU, hey, no deal whatsoever with the Brits until they give up their negotiations on the fishing rights, right? Now, UK's position was, okay, screw EU, we'll go to America, Uncle Daddy, Uncle America is going to protect us, they're going to give us a great trade deal, and what we're going to do is we're going to basically be an arbitrage point, a place where since we'll have no tariffs on our land, will be United States is gonna import into UK and sell to EU at a massive markup because we will be kind of like a legal arbitrage, right? So that thought has really gotten blown up for one following reason. UK has made a deal with Huawei to do 5G installation, and Trump, of course, at the moment he heard that, just gave Johnson an unbelievable yelling and told him, "Hey, screw you! We're not going to give you any kind of a deal." And even if UK was going to relent on the 5G, which I don't think they can because they simply don't have any other way to create a 5G network, Trump is very unlikely to give UK any kind of preferential treatment in anything because he's going to want huge amount of value, and especially, for example, in pharmaceuticals and patent protection for the U.S. for U.S. Manufacturers out of UK. Bottom line is, what's happening is UK is a tiny, tiny, tiny little country, right? It's used to be a big empire. It thought it can still be a big empire, and this is the ultimate, I think, exercise in arrogance, that they think the rest of the world is going to not take advantage of them. What's happening right now is the rest of the world is going to just pummel the living crap out of UK. Now, all of that is fine and dandy, but the real existential threat to United Kingdom economy is financial. We all know that London is the center of the financial world, right? It stands between Asia and North America because of time, because of location, because of very, very long expertise in the area. The City of London essentially is responsible for something like 12% of all UK GDP, right? It is in fact the only thing that UK really does well. Now, what can completely sabotage that whole arrangement is if the Europeans just decide, you know what? Sorry, all of those financial instruments, all of those swap contracts, all of those derivatives that you guys trade in London, we're not going to allow that to happen anymore. All clearing now has to move to the continent. In other words, if you're out of London and you're trying to trade with everybody else in the world, we're not going to recognize you as an agent. You need to be registered on the continent. That happens, that destroys, that completely hollows out the City of London in faster than you can imagine. And that is the existential threat to the UK economy, because that's like 15% of the UK economy and probably, I don't know, 50% of its taxes. It's the only productive component of the UK economy, and that's what can really threaten UK going forward. So to me, pound is a sell the rally trade over and over and over again, irrespective of whatever mild pop-up in sentiment, whatever mild improvement in economic growth you have here as just temporary, statements over the year. So now, let me see if I have any questions here before. Okay. Still, lots of people still having issues with sound. I don't know what's going on. Maybe it's your locations. Hopefully everybody else is hearing me well. As I said, all of this is going to be recorded. So now, since I see no questions, let's get to the best trades of the year, and then I'll show you a couple of strategies that we like to use, and then we'll wrap up with a Q&A. So here's my thoughts for best trades of the year. When it comes to trading equities and indices, I am the first one to caution that this has to be a long-term trade, and that this could be a huge pain trade. Right, it's certainly been a pain trade for the past month or so, and it may take a while for this trade to work. But I am very much convinced that when all is said and done, this is going to be an interesting long-term trade. What you see here is essentially the Dow Jones against the NASDAQ, right? For all intents and purposes. And the absolutely massive outperformance of NASDAQ over the Dow Jones. Remember, these are effectively the same companies. what's the difference? Why is technology and why is NASDAQ literally almost twice as much? This is unprecedented in American history, where you have two indices, one index outperform the other industry of essentially the same asset class so much. And that's essentially the function of FANG stocks, right? Apple, Google, Facebook, Netflix. If we have any kind of a long-term global wobble, all of those stocks, all of the valuation, including, by the way, it's not even in here, but the poster child for complete and total speculation is now, of course, Tesla, which is worth more than GM and Ford and I think even Chrysler, Daimler combined as a trade. Just to give you an idea, I'm old enough to remember when the land in the Tokyo Imperial Palace, the land underneath the Tokyo Imperial Palace was worth more than all the land in California. And everybody was saying that Japan is going to be the next dominant player of, it's going to be the number one economy in the world, and that's why all of this was valuable and true. And of course, it's all nonsense. And same here is the same. Tesla will be $200 a share eventually, maybe even less. And NASDAQ will compress when there's a correction much harder, much faster than the Dow Jones Industrial Average. Fear greed now is literally at 97. This is all kind of old. Volatility is kind of low. All of these structures suggest there's going to be a correction. And if you're going to do a correction, then I think some interesting way to trade a correction in equities, the sort of safest way, the simplest way, is to be short the NASDAQ, long the Dow Jones, right? On a CFD basis. Here I'm using US symbols because we don't trade CFDs in the US, but for you guys, you would just simply in dollar equivalent, meaning that the equivalent amount of NASDAQ against the Dow Jones. The way it works, I think it's sort of the ratio. Let's say NASDAQ is around 10,000 right now, Dow Jones is around 29,000. So what you would do is you would sell 3 NASDAQ CFDs against 1 long US 30, what's called US 30 on the CFD side. So it's a 3-to-1 ratio. And if you hold that spread, I think that spread is going to start working for you, meaning that the NASDAQ is going to start correcting sharper and deeper than the decline in the Dow, and the difference between the two is going to give you, hopefully give you a profit. So that's my one idea for 2020 as an equity trade. Another one, and these are all sort of option ideas on the US. You could do this with CFDs just without. This is much more complicated than it needs to be in America, but in everywhere else across the world, you obviously have access to CFDs. Is to simply, you could short the NASDAQ itself, just plain, plain out. That's a much more dangerous trade because obviously, it can squeeze a little bit higher. But honestly, how much more higher? 5%. The key, let me rephrase all this. All of these trade ideas are long term, so they would require minimal amount of leverage, maybe 2-to-1 leverage at most. Maybe 3-to-1 if you really were gambling. This is not a kind of a thing where you want to go 50-to-1 lever on any kind of a trade, or you don't want to go 50-to-1 lever on being short the NASDAQ, because you could easily have another 5% move to the upside. But we are closer to the end than anybody can imagine. Now, on the gold side, obviously being long the metal just on a purely CFD basis is an easy trade. Another easy trade, if you want to trade this, and this is available in CFDs for you guys, sort of a simple trade, is to be long Newmont Mining, NEM. So Newmont Mining is the biggest, let me just go back to this chart, is the biggest miner in the world. It's also part of the S&P 500. And the reason why that's kind of an interesting stock trade is because as part of the S&P 500, if gold starts to rally, all miners, anytime you have, I don't have to explain this to you guys because you know this better than I do, anytime you have a rally in the underlying metal, the earnings of the miners go up tenfold. So the equity is going to start rising. But because it's the only one part of the index, everybody who owns the index, since most stock investing is done through index investing, it's by nature going to really create massive inflows into the stock. So to me, the simplest, cleanest way to trade gold, if you don't want to trade the underlying metal, is to buy Newmont Mining as a trade. The other ideas that I had there are much more for U.S. centric accounts because they involve options and all sorts of convoluted strategies. But the one thing I will say about trading gold to the long side, if you're just trading this on a purely instrument basis, the single most important thing that's really, really important is to have gold close, and this is the key thing, close above the 1600 level. If you can close above the 1600 level, then you have a chance. Or not that you have a chance, but you have a very, very strong signal that gold is going to try and take out the highs at around 1800. That to me, until and unless we close on a monthly basis above the 1600, we still don't have the confirmation signal of a full break-on rally. There's no doubt in my mind that gold is a buy to dip story, but a full breakout story would be a close above the 1600. That would give you just complete green light to go out there and get crazy on gold. And then the third idea for the year is, as I said, my very, very negative view on cable. Now, expressing it by being long euro pound, in retrospect, with euro being so badly beaten up, may not be the best idea ever. But it's not horrible. It's not horrible because I still think pound is going to underperform euro in the long run. With coronavirus and equity indice risk off potential, it may be better, as I look at this, if you want to take a fundamentally short view on the pound, it may be better to trade pound yen to the downside. It's going to be much more volatile. The reason why I chose euro pound is because it's a sort of a much less volatile trade. It's not, you don't have to. You could just basically have a 200 pip stop, and you could probably survive all the intra-week oscillations, and ultimately have this thing move to the 90s. Pound yen is going to be a lot more volatile, but it will also give you a much bigger payoff. So perhaps a smaller size with much wider stops, but a pound yen to the short side would be the right trade on the currency side as my trade of the year on currency sides. So we have a couple of minutes. Let me see. I don't have. Frank is asking me if I have any ideas in oil. I don't have any ideas in oil. Oil has gotten so shellacked at this point, and I don't have any. Can oil go down to 40? Yes. Can it pop back up to 60? Yes. The point is, I don't have any definitive, clear beliefs that it will go one way or the other. Gold has really strong underlying demand composition. Cable has really strong underlying fundamentally negative story behind it. And NASDAQ is grossly overvalued against the Dow Jones. So that's why I chose those three. Those three have three really compelling reasons for why you want to trade it that way. Everything else is a punt. So that's why I kind of choose it, okay? So again, everybody's asking me about dollar CAD and everything else, and I don't have any good reasons. The reason I haven't chosen anything else is because I don't have any strong narratives that I have a lot of confidence in. I have a lot of confidence in these three narratives. I don't have as much confidence in the other ones. That's why I haven't chosen them. Doesn't mean they're not good trades. Doesn't mean that I'm not wrong. But those are my narrative stories that I think are good for 2020. Okay, I want to just share with you a couple of strategies that my partner Kathy trades, just so you guys can look at some ideas, even within this particular structure that I gave you, or just generally trading ideas in how she looks at trades. This is a very, very simple setup that can be incredibly effective. And the idea here is across any instrument, we're using a Bollinger Band. We're gonna put two sets of Bollinger Bands on a chart. One set is the normal 2020 20 SMA with a 2 standard deviation, and the other band is 20 SMA with a 1 standard deviation. And what that creates is it creates a what we call a dynamic trend channel. So when price is in the upper Bollinger Bands, it's clearly trending up. When price is in the lower Bollinger Bands, it's clearly trending down. The shift in regime from up to down happens on the breakout of these bands. So when price loses the 1 Bollinger Band support, right, when it drops down here, that's an interesting short. When price breaks out to the upside on the Bollinger Band, that's an interesting long. These things provide some very, very interesting. They don't always work, but they work quite a lot. They work especially well in range-based instruments where there's a lot of where there's just sort of clear tops and bottoms. Finding the turns from up to down using Bollinger Bands is a really interesting way of trading. And you can see this is how we basically do it on a short side and then to the long side. And she likes to trade it with what's called a 2-unit structure, where she will enter the position, have a short exit, lock down the profit, move the stop to break even, and then see if she could manage the rest of the position for a much, much larger move to the downside. You can do this on daily charts. You can do this on hourly charts. You can do this on 15-minute charts. It's very, very flexible setup. I just wanted to share this with you. Happy to show this with you, when we do this. And then another way to take a using double Bollinger Bands is to enter existing trend at value. So the way that works is it's essentially a retrace trade. It's a retrace trade within trends. So what happens is you have price channeling in a downward Bollinger Bands, right? It's one of the ways we know that we have an extraordinarily strong trend is when something is what's called walking the band. This is a 2 standard deviation band, and price is just sitting there on 2 standard deviation, highly, just selling it hard, right? Same way to the upside. You don't quite have this to the upside here with such intensity, but here it walks the band to the upside, up hard. Every close is on the band. When it's walking the band, that's a very strong, that's as strong an indication of an uptrend or a downtrend as you're ever going to get. So then eventually it gets tired. And it peels off the band, and price sort of, gives up its downward trajectory, consolidates, or it gives up its upward, trajectory and consolidates. If it comes back to the 1 standard deviation and then comes back down, like sort of touches this, comes back down, that's a great retrace trade. Like entering here, you still have more downside action, to the downside coming in. It doesn't matter whether the candle is red or green. Like for example, here's a green candle over here. You could enter here. You obviously have a very very cleanly defined stop. You could just use the high of this candle as a stop. And as long as it doesn't break from the Bollinger Band to the upside, you have a chance for continuation to the move here. Well, over here it kind of falls out. Like, or let's say if you were to enter over here, here's a good way of looking at it. So you have this walking the band, not a very intense trend over here. It's walking the band, and then it comes in over here, and let's say you decide to buy. If you buy, your risk is minimal. Your risk is just this Bollinger Band break. As long as if it breaks the Bollinger Band, then you're out of it. You're wrong, and you can see how quickly if you're wrong, it's a very very small risk. If you're right, you have a chance for continuation at value. This provides very very good value trades, sort of retrace trade positions in the trade. Here, here's the good example where you short the stuff, and you could trade it with these rules. One other thing that my partner does very very well is she likes to combine technicals with fundamentals with a macro view. And one of the things that we do at BK, if you're interested, is Kathy every single week publishes what's called a fundamental heat map, where she looks at the underlying fundamental value of each particular currency. And then what she will do is she will combine the strongest currency with the weakest currency. And if she gets a technical confirmation that indeed the weakest currency is let's say in this particular case she wants to sell pound Aussie because pound is bearish and Aussie is bullish. Just this is an old, obviously January 13th chart. We would have changed. she looks at that, and then if she has a technical confirmation where pound Aussie starts to break down technically, she will trade that. And the combination of having the fundamental oversight along with the sorry about that, along with a technical confirmation provides very, very, very strong results. Her trading has been super, super effective. She's trying to basically achieve about 100 pips a week, and she has been able to achieve that. And as a matter of fact, this last week that we did about 138 pips. So it's been very, very consistent by combining, this process into a very, very good trade. So that's pretty much it. Perfect timing. We just made it into an hour. I am very happy to take any questions. Let's see. So Frank is asking me, do I recommend trading euro pound over cable? Euro pound is just a lower volatility expression of the same idea. Okay. So up to you. You're probably going to get much more pips out of cable short than you will out of a euro pound long, but you also will have to absorb. I think if you're trading the pound story, you have to give yourself 500 pips of breathing space against all of the all of the positive news that quote unquote positive news that you're going to get out of UK. So to me, if you look at the pound, you probably need to be at around 135 stop or somewhere around there. If it goes through 135, I'm clearly wrong in my position. But I think it's going to hold and eventually break down towards the 125s as we go forward. Okay. Great. I'm glad somebody liked the webinars. Kathy's heat map is only available for BK members. So sorry, that's a proprietary thing. Please, if you'd like to join us, love to have you there. Target for pound, I think 125 is your first initial target. Ultimately, I think it can go as low as 120. It all depends on how patient you are, how big a view you have. But ultimately, I think cable can go to 120 on this. All right. Okay, my friends, I thank you very much. I want to just tell you, we will obviously send everybody a notice, but very exciting news. I am doing Trader Fest 3. Some of you may have been in my Trader Fest before, but we have a unbelievably cool Trader Fest, including I got my partner to come in and disclose exactly how she trades. She's going to show you her whole process, exactly how she makes 100 pips a week for the last, I don't know, 55 weeks in a row or something, including, and then I also have a whole bunch of other traders, including Ashraf Laidi, who's a very, very, very well-known analyst who's going to tell us all about Brexit. And that's going to be coming up March 14th. We're going to send you information on how to register. So I hope everybody who's come to this webinar, please come to Trader Fest 3. It's going to be an awesome event. I'm going to have 6 traders, and we're going to be talking about process. That means we're going to talk not just like, oh, I feel good, I feel bad. We're going to show you exactly how we trade strategies. That's going to be super valuable for everybody. And of course, we will have all the information available for you for download on that. So please, Trader Fest 2020, register if you guys want to. But otherwise, we'll send you a copy later. So let me see if I have any more questions. Okay, sounds good. Everybody's no more questions here. Everybody seems to have enjoyed this. Let me see if there's anything else. As I said, Frank, stops and take profits on very large trades. If it's euro pound, it's got to be 200-300 point stops. If it's pound, it's got to be 500 point stops. You have to, when you're talking about year-long trades, they have to be much larger positions. And same thing with gold, by the way. With gold, by the way, just to give you just anchoring points, if gold to me, I can't turn bearish on gold. That means really, I'm wrong gold only if it's $1,400 or below. So you have to give yourself that much room, just to understand, that much room in order to really let these trades go out. They're going to be tested. They're going to be challenged. To me, if you're trading on a long-term basis, that's kind of a vision you have to have. So you have to give yourself 1,400 to the stop on spot gold, which is far, far away from here, obviously. But the potential here is 2,000 an ounce if the gold story really develops. That's how you got to be thinking about all these things. Thank you so much, guys. Everybody have a wonderful time. We're going to send you the video of this, I'm sure, and then we'll send you all the information on TraderFest 2020. I'd love to see you guys there. Thank you again. Everybody have a wonderful day. Take care.